Welcome to the deep dive. Today we have a really fascinating stack of sources. We are unpacking something called Price Action Model 3 from the Inner Circle Trader framework. ICT, if you're familiar with it.
Yeah, ICT. It's a very specific model.
Right. And the mission for our time today is, well, it's highly targeted.
Right.
We're looking at a blueprint designed for what the sources call the working class hero.
I love that term.
Yeah, it's great, right?
Yeah.
I mean, this is for you if you have a full-time job or maybe a business to run, or, you just have zero desire to spend 10 hours a day staring at, like, flashing 1-minute charts.
Exactly, because let's be real, most people just don't have the time or the psychological bandwidth for that kind of hyperactive day trading.
Right, totally. So we're going to break down how to capture these significant market moves over days or even weeks with minimal screen time. And the key is learning to read the market's underlying institutional footprints.
It's an incredibly practical approach, honestly. We're sort of moving away from that frenetic energy of day trading
Yeah.
and stepping into like an intermediate swing trading mindset.
Okay, swing trading.
Right. The goal isn't to catch every little fluctuation. It's to align yourself with the dominant forces in the market.
Yeah, and reading through these sources, I kept picturing this scenario to kind of make sense of it all. Like, imagine you're standing ankle deep at the beach, just watching the water.
Okay, I'm picturing it.
If you only look right at your feet, the ocean seems completely chaotic. I mean, waves are splashing in every direction, ripping erratically. You might think you can predict the next little wave, but then a random, slightly bigger one just, bam, knocks you right over.
That's exactly how most people experience the markets.
Right.
They are entirely focused on that surface noise. They're trying to time the ripples, and they're completely missing the underlying tide that's, well, moving billions of gallons of water with absolute undeniable certainty.
I got you. So before we even think about clicking buy or sell on a trading platform, we have to figure out what that underlying tide is actually doing.
Precisely. You have to step back.
And the sources are very clear on this. We start with the macro view. Everything is anchored to the monthly chart. But the notes specifically say we are anticipating the expansion of the monthly candle, not the close. I'll be honest, that distinction threw me a little bit.
Yeah, it's a subtle but really crucial difference. Think about it. If you're trying to predict exactly where a monthly candle will close, you're essentially trying to predict the future 30 days out.
Which is impossible.
It's a fool's errand, yeah. Anticipating the expansion simply means we are trying to figure out the broad direction the month is likely to travel.
Okay, so just the general flow.
Exactly. If we determine the overall tide for, say, May is bullish, meaning the price is generally pushing upward, we don't care where it officially ends on May 31st. We just want to catch one or two really solid weekly runs within that overall upward flow.
Okay, yeah, that makes total sense. We're hitching a ride on the momentum, not guessing the final destination.
Yeah.
But how do we actually know which way the month is going to expand?
Well, that's where the data comes in.
Right, because the sources outline a very specific custom tool for this, the Commitment of Traders Hedging Program. Now, I know the Commitment of Traders, or the COT data, is public information released by the government, but this model reads it in a highly specific way.
Extremely specific. Most retail traders look at the raw COT data and just get totally lost.
Yeah, it's a wall of numbers.
Usually because they look at all the participants combined. But Model 3 dictates a very disciplined filter. You look back over the last 12 months of COT data, and you isolate only the commercial traders.
Only the commercials.
Right. You completely ignore the large speculators like the big hedge funds, and you ignore the small retail traders.
Wait, I have to pause you right there. Why ignore the massive hedge funds? I mean, aren't they the ones throwing billions of dollars around and moving the market?
It seems that way, right? But hedge funds are trend followers. They are, at the end of the day, just speculators. The commercials, on the other hand, are the actual producers and end users of the underlying assets. Think of a massive multinational chocolate company buying cocoa futures.
Oh, right. Or like a global airline hedging fuel costs.
Exactly. They aren't trying to guess the market. They are using the market to lock in operational costs. Because of their massive physical exposure, they have the deepest pockets in the world. They are the actual smart money.
Right, I get it. So we focus solely on the commercials. And the time horizon is exactly 12 months. Why 12 months? Why not like a 5-year average or just the last quarter?
Good question. A rolling 12-month window perfectly captures a full business cycle.
Oh,
Yeah, it includes all 4 quarters of seasonal hedging, inventory building, operational adjustments. It basically gives you a complete picture of how these massive entities operate over a full year without watering down the data with ancient history.
makes sense. So practically, the sources say we take that 12-month data for the commercials, we find the absolute highest point of their net positions, we find the lowest point, and essentially draw a box around that range.
Right, you map the extremes.
And then we find the exact midpoint of that box. What does that midpoint actually represent?
Think of that midpoint as the equilibrium of commercial hedging over a full business cycle.
Okay.
It becomes your new custom zero line. It tells you the baseline cost of doing business for the smart money. If the current price is above that midpoint, we classify it as a commercial buy program.
Meaning the tide is in.
Exactly. The underlying tide is fundamentally bullish. If the price drops below that midpoint, it is a commercial sell program. The tide is bearish.
I really like that. Going back to the beach analogy, that 12-month COT midpoint is our tide indicator. Even if the surface waves, the retail traders are violently splashing down on a Tuesday afternoon, that midpoint tells us if the underlying ocean tide is fundamentally pulling out or rushing in.
That's a perfect way to visualize it.
So let's say the COT data tells us the tide is rushing in, we want to buy. But institutional money isn't just buying blindly into the void, right?
Yeah.
They are aiming at something. What is the magnet pulling the price upward?
That brings us to the core objective of the market algorithm. The market is always drawn to one thing, and literally one thing only: liquidity.
Liquidity pools. Okay, this is heavy finance jargon, but the sources frame it in a way that is incredibly practical. Let's break it down for the listener. What is a liquidity pool?
At its simplest, a liquidity pool is an area on the chart where a massive cluster of stop-loss orders is resting.
Okay.
When retail traders place a trade, they are taught to place a protective stop-loss just above a recent high or just below a recent low. When thousands of traders do this at the exact same price level, it creates a pool of available orders.
Just sitting there.
Right, just resting. Usually you'll spot these as an old high, an old low, or what we call equal highs and equal lows on the daily chart.
And this is where the sources get a bit ruthless, honestly. They use this amazing predator and the herd analogy. Think about a standard retail trading textbook. When you see two peaks side by side on a chart equal highs, what does the textbook tell you that is?
Well, it tells you that's a double top. It's pitched as a brick wall of strong resistance.
Right, like an impenetrable ceiling.
Yeah, and the textbook says you should sell against it and put your stop loss safely just above those two peaks.
Exactly. So the retail herd naturally gathers there. They all tuck their buy-stop orders right above that invisible line. But an institutional predator doesn't see a brick wall.
No, not at all.
They see a massive, vulnerable cluster of orders. They see the sick wildebeest.
That's exactly it. If a major institution needs to buy or sell hundreds of millions of dollars of currency, they can't just click a button like you or I can.
So there's not enough volume, right?
Right. There isn't enough opposing volume. They would cause massive slippage and basically ruin their own entry price. They need a huge pool of opposing orders to absorb their position.
Wow.
So where are they going to find a massive cluster of willing buyers or sellers? Right above those equal highs or right below those equal lows. The market doesn't move randomly. It is mechanically engineered to hunt those specific pools of liquidity.
So as a swing trader, if I know the tide is bullish, I'm going to look at my chart to find those equal highs because I know the institutions are going to drag the price up there to trigger all those retail stops.
Precisely. You target what they are targeting.
But how far back on the daily chart do I look? I mean, if I scroll back 5 years, there are equal highs everywhere.
You don't scroll back forever. The pricing algorithm has a memory, and it prioritizes recent data. The model defines a strict dealing range called the IPDA data range. That's the interbank price delivery algorithm.
IPDA, got it.
First, you look back exactly 20 days on the daily chart. If there's an obvious liquidity pool there, like a glaring double top, that's your primary target.
Okay, 20 days.
But if the last 20 days are messy, you expand your look back to 40 days, and the absolute maximum is 60 days.
So anything older than 60 days is essentially stale bread to these institutions.
That's right. You are targeting an old high or low within that 20 to 60-day window. It provides a low resistance path for a liquidity run.
All right, let's synthesize where we are. The macro picture is set. The 12-month COT midpoint says the tide is coming in, we are bullish. We look back, say, 40 days on our daily chart, and we spot a beautiful cluster of equal highs just waiting to be hunted.
Perfect setup.
We know the direction, and we have the target. But If we just hit buy at market price right now, we're probably going to get swept away by a surface wave before the tide ever reaches our target.
Absolutely. Entering blindly in the middle of the range is how you endure massive drawdowns or just blow up an account. We need a precise institutional entry point that offers very low risk for a high reward.
Okay, the actual entry.
Yes, and this is where we have to drill down into the mechanics of the candlesticks themselves. We're looking for order blocks and fair value gaps.
Let's translate these because that's more jargon. I'll take a swing at order blocks first.
Go for it.
If I'm looking for a bullish entry, an order block isn't just any red downward closing candle. It's a very specific down-close candle that happens right before an explosive move upward. So is it basically the exact footprint of where the institutions pause to pair their massive block orders before launching the price?
That's a really great way to visualize it. Institutions don't enter all at once. They manipulate the price down, creating that red candle to accumulate their final batch of buy orders at a cheaper price.
Oh, right.
And then they aggressively step on the gas. That specific candle is the order block. When price eventually drifts back down to that level, the institutions will often defend it, providing a high probability entry point for us.
Okay, got it. Now what about a fair value gap or an FVG?
An FVD is a price imbalance. It happens when the market moves so violently in one direction that it leaves an empty space on the chart. Visually, if you look at 3 consecutive candles, it's when the middle candle is huge and the wicks of the first and third candles don't overlap at all.
Like a gap.
Right. It means price blasted through that zone so fast that only buyers were present. There were literally no sellers.
The analogy I loved for this from the sources was comparing a fair value gap to a rushed, sloppy paint job on a wall.
Oh, yeah, that's a classic.
The painter being the market swiped the brush across the wall so incredibly fast that they missed a huge spot in the middle. But the market is a highly efficient machine. It doesn't like empty spaces. So it almost always has to come back down, apply a second coat, and rebalance that empty space before continuing in its true direction.
Exactly. It has to offer fair value to both buyers and sellers at every price level. So yes, that second coat retracement is your entry window. In Model 3, you wait for the price to retrace back down into that order block or re-enter that fair value gap.
And then what?
When it does, you use a Fibonacci retracement tool. You measure from the recent swing low up to the swing high, and you're looking to enter your trade specifically in the 62% to 70.5% retracement zone. ICT calls this the optimal trade entry, or OTE.
Now wait, why that specific zone? Why not like a 50% retracement? Half off sounds like a pretty good deal to me.
Half off is a retail discount. Institutions deal in deep wholesale discounts. At 50%, the market is simply at fair value. It's neither expensive nor cheap. But when price drops into the 62 to 70.5% range, it has crossed the threshold into a deep institutional discount. That is where smart money prefers to accumulate.
Okay, but remember our listener profile here. We are talking to the working class hero. We can't sit at our desks 24 hours a day waiting for the market to drift into a 62% discount. How do we manage the time commitment?
You manage it by only looking at the charts during highly specific windows.
Okay.
You look for these optimal trade entries to form ideally on a Monday, Tuesday, or Wednesday. Thursday and Friday are often just reversing the weekly range, so we avoid them for new swing entries.
So early in the week.
Right. And intraday, you only look during the London Open or the New York Open kill zones. These are specific 2 to 3 hour morning windows where the massive banking volume floods the market.
Now, the sources also mention filtering these entries by converging them with the standard deviation of the Asian overnight trading range or the central bank dealers range. I mean, that sounds incredibly complex. What are we actually measuring there?
Let's demystify it. The central bank dealers range, or CBDR, is simply that quiet period late in the New York afternoon into the evening when volume dies down and price just drifts sideways in a tight little channel.
Okay, just sideways movement.
Right. The Asian range is similar. It's the overnight consolidation. What we do is measure the height of that boring sideways channel. Let's say it's 20 pips high. We then project standard deviations, multiples of that 20 pips, up and down from the channel.
But why do we care about multiples of a boring overnight session?
Because manipulation is mathematical.
Oh.
If price suddenly spikes aggressively out of that Asian range during the London Open and hits exactly 2 or 3 standard deviations, say 40 or 60 pips down, and perfectly taps our optimal trade entry level, well, that's not a random market move.
It's deliberate.
It is a calculated, engineered fake-out, a Judas swing designed to grab liquidity before reversing into the true daily direction. When time, price, and mathematical deviation align like that, it's a massive green light.
Okay, I'm seeing the matrix here. We found the 12-month COT tide. We identified the daily liquidity pool at an old double top. On a Tuesday morning during the New York kill zone, the market mathematically fakes out downward right into a fair value gap, hitting the 70.5% institutional discount level.
Beautiful.
We click buy, the perfect entry, so we can just kick back and count the money.
I really wish it was that simple. But you've actually just finished the easy part.
The easy part.
Yeah. Identifying the setup is mechanical. What comes next is the absolute hardest part of swing trading: psychology and risk management. The mental discipline required to hold a swing trade for days or weeks, watching the price fluctuate without sabotaging your own position, that is what separates professionals from the 90% of retail traders who lose money.
Yeah, this is exactly where the sources shift from being an analytical guide to taking on a very stern, almost trader mentor vibe.
Because capital preservation is everything. The golden rule drilled into you here is you are trading your equity curve, not your stop loss.
Let's really unpack that. Trading your equity curve. What does that mean in practice for someone sitting at their laptop?
It means retail traders are obsessed with their stop loss. They execute the trade and immediately stare at the floating loss. They watch the price tick down, they panic, they move the stop wider to avoid the hit, or they close the trade early just to relieve the emotional pain.
Right, staring at the red numbers.
Exactly. A professional trader accepts the risk the moment they click the mouse. You place the stop loss where the technical structure dictates it should go, say, just below that order block, and then you leave it completely alone.
Just walk away.
Yes. Your only focus moving forward is the institutional narrative still intact? Is the tide still pulling my way? If yes, you sit on your hands and let the equity curve do its work.
And the parameters for that equity curve are incredibly tight in this model. The sources dictate risking a maximum of 1% of your total account on any single trade. But there's a scaling rule here that genuinely fascinated me.
The drawdown rule.
Yeah. It says if you take a loss, you must drop your risk by 50% on the very next trade. So if you risked 1% and lost, your next trade can only risk 0.5%. And you cannot raise it back up to 1% until you have recovered at least 50% of that initial loss.
It is a mandatory self-preservation protocol. Look, every single trade you ever take opens as a loser. The second you enter, you are negative because of the spread, the small fee, the broker charges to execute the trade. And because of the nature of probabilities, you will eventually hit a losing streak. It's unavoidable.
But I can hear people listening to this rolling their eyes. I mean, if I have a small account, say $2,000, risking 1% is $20. If I lose, my next trade I'm only allowed to risk $10. Making 0.5% on a win feels like I'm wasting my time. I'm barely putting a dent in the loss I just took.
I completely understand that frustration, but that mindset is exactly why small accounts blow up.
How so?
If you maintain maximum risk during a losing streak, say you lose 3 trades in a row at 1% each, you aren't just down 3%, you are emotionally compromised.
Ah, the revenge trading starts.
Exactly. You start forcing trades to make it back. Throttling down your risk to 0.5% isn't about making the money back in one shot. It's about repairing your psychology while keeping you in the game. It forces you to weather the storm without experiencing massive drawdowns. It turns your equity curve into a smoothed-out staircase rather than a terrifying, account-destroying roller coaster.
Okay, I understand the logic for throttling down when you're losing. That makes sense. But I have to push back on the very next rule in the notes. It says if I hit a winning streak of 5 trades in a row, I also have to cut my risk by 50% on the 6th trade. That seems completely counterintuitive. I mean, if I'm hot, if I'm reading the market matrix perfectly, shouldn't I press my advantage and size up?
Absolutely not. That urge to size up is exactly how the market traps you. When you hit 5 wins in a row, you get what veteran traders call the King Kong feeling.
The King Kong feeling.
Yeah. Your ego massively inflates. You genuinely start to believe you've cracked the code and you can't miss. You want to post screenshots online to show everyone how brilliant you are.
I mean, we've all wanted to post the winning screenshot, let's be honest.
Of course, it's human nature. But what inevitably happens next? Because you feel invincible, you get sloppy. You take a subpar setup that doesn't perfectly meet the criteria, or worse, you over-leverage to prove a point. And because you force the trade, you take a massive loss.
And you can't post that online.
No, you can't. You feel humiliated. And that humiliation leads directly to revenge trading to win the money back quickly, which leads to deeper losses. It's known as the loser cycle.
Wow.
Capping your risk after a winning streak has nothing to do with the math of the market. It is entirely about capping your own ego before it destroys your account.
That is profound.
Yeah.
You are literally managing your own human nature as much as you are managing the chart. So, assuming we survive our own egos, how do we actually manage the open trade? We're in profit. When do we cash out?
You scale out systematically. Because this is a swing trading model, you determine your partial profit targets based on the daily chart, not the lower time frames. Let's say you spot resistance at 50 pips or 75 pips away. When price hits that level, you take a portion of your position off the table.
Lock it in.
You secure your pound of flesh to ensure the trade is profitable, but, and this is the absolute key to making swing trading worthwhile, you always leave a small portion of the trade open.
Runner.
Exactly. You leave that last piece of the position open without a hard profit target. You manage it simply by trailing your stop loss behind the price as it moves up.
Why not just take it all at the target?
Because in extreme market environments, the monthly expansion can run far beyond what any standard technical analysis predicts. The sources actually cite a Euro-Aussie trade setup that ran over 3,000 pips.
3,000. Wow.
Yeah. If you limit yourself to a strict 200 pip take profit target, you cap your potential and miss the mega trade. By leaving a runner, a tiny initial risk of 25 tips can turn into a monumental quarter-making windfall.
So bringing this all together, what does Price Action Model 3 actually mean for the listener? The core value here isn't just about extracting money from the market. It's a patient, highly disciplined lifestyle approach. It's accepting that you don't need to catch every tiny intraday ripple.
Exactly.
By stepping back, identifying the commercial pie on the 12-month COT, hunting those daily liquidity pools, and waiting patiently for an exact mathematical retracement during a kill zone, you can participate in massive institutional moves. And you can do it while still running your business, doing your job, and living your life. You aren't a slave to the charts.
It fundamentally shifts your perspective. It's about working smarter, finding where the deepest pockets in the world are placing their money, and quietly aligning yourself with those dominant market forces rather than fighting them. It requires patience and immense self-control, yes, but the clarity it provides is profound.
It really does change how you view everything on a chart. Which leads to a final, slightly provocative thought I want to leave you with today. If you're listening, think about this from day one. Anyone who gets into trading is taught to look for textbook retail patterns. Double tops, head shoulders, trend lines, harmonic patterns.
Standard stuff.
Right. But if the markets aren't random, and if institutions specifically need to hunt massive pools of liquidity to fill their orders without slipping the price, then maybe those beautiful textbook retail patterns aren't naturally occurring phenomena at all.
Well, they definitely aren't.
Maybe they are engineered bait, deliberately painted on the chart by the algorithm to build the very liquidity pools that the smart money needs to hunt.
It's an uncomfortable thought. But if you sit down at a chart and you can't spot where the liquidity is, you are the liquidity.
Exactly. So the next time you open up your platform and see a perfect textbook double top practically screaming at you to trade it, take a step back and ask yourself, are you the predator looking at the commercial tide? Or are you just another sick wildebeest splashing in the waves?